Welcome back. Futures indicating a decline at the start of trading this morning. The Dow Industrial's down 127 right now. The Nasdaq is down 70 ahead of the Federal Reserve's two-day September policy meeting, which begins today. Interest rates have been soaring. The 2-year and the 10-year Treasury yields both hitting their highest level in more than 10 years. Take a look at the numbers with the yield on the 2-year at 3.984% and the yield on the 10-year now at 3.54%, up almost 5 basis points. Markets are fully pricing in at least a 75 basis point hike this morning. There is 18% of the market saying they'll expect a full percentage point hike. Tomorrow afternoon, we will get the news at 2:15 p.m. Eastern. Joining me right now to preview is Kyriba senior strategist Wolfgang Koester. Wolfgang, great to see you this morning. What do you think the impact of this aggressive tightening will be? How do you see this playing out?
Well, I think we're going to keep seeing the interest rates keep going out. You saw that over 75 central banks have been raising their rates, 40 of them in excess of 50 basis points. 75, as you already mentioned, is in the market. I think that 100 is at this point kind of aggressive because they should have done that earlier, quite frankly. So now is almost like too late. You should have had that impact earlier. That's why I don't think they're going to go to 100 basis points on this raise. What does it mean? It means that for investors, it means that they really need to go back to the basics and look at value. One of the ways you look at value is let's look at the cash flow. What companies have good cash flows and how are they managing their cash flows? More important than ever. Interest rates are going up, cost of capital going up. Having good forecast and the ability to forecast revenues and earnings, very important. Those are the companies to invest in.
Well, we're looking now at yields at multi-year highs, and that has certainly created some demand destruction in a number of industries. Take housing. The National Association of Home Builders CEO says it's a real bad time. We've given birth to a housing recession. The National Association of Home Builders sentiment fell for the 9th straight month yesterday to the lowest since May of 2020. And, of course, we're looking at new data out this morning. Mortgage rates top 6%. Also bringing down home goods retailers, Wolfgang. So there's been a lot of impact here throughout the housing-related sectors. What do you think the industries that we need to watch in terms of the biggest impact from these higher rates?
I think that the healthcare is going to be very interesting. Obviously real estate is, but on the positive side, a lot of technology firms are, I think, still interesting. And right now, you've seen a lot of private equity firms actually buying publicly traded companies and taking them private. I think that's an area to really start looking at because they're not going to be as impacted as long as they manage their A, interest rate risk properly, and B, quite frankly, American firms particularly, the dollar. Dollar strength is continued to something that we're going to continue to see. High volatility in those areas. How are they managing those two key factors? And then look at value. You just saw Adobe making a pretty large investment, pretty highly valued, some questions around it. But that shows you that there's still a significant interest in the technology space.
Yeah, no, I understand you're identifying areas to hide in during this upset. But, Wolfgang, what I was saying is what industries are getting impacted the most from this squeeze from higher interest rates? Because you have seen demand destruction in housing. And the Journal yesterday wrote about furniture companies because they're attached to housing. Are there any other areas that you think are most vulnerable to higher interest rates for a potential hit on profits?
I think that's anything that's related, for example, appliances is going to be, all of a sudden, you're going to be able to get your appliances, whereas before you were waiting for quite a while. So actually going to have negative impacts on that. They're not anything that's related to building houses. As it slows down, you're going to have slowdown in those areas, appliances certainly being another one of those. But as you say correctly, is we have all of a sudden not free money anymore, mortgage rates over 6%. But we do remember in the Volcker days and the Carter days when everybody was excited that we broke under 10%. So we've been having a significant material increase in real estate prices. That they're now coming back is not surprising.
Well, you know, I mean, with the 30-year fixed rate mortgage now at 6.02%, it was just a year ago that level was at 2.86%. So you're talking about a more than double. Mark Tepper is with me this morning. Mark, jump in here.
Wolfgang, good morning. I'd like to ask you a little bit
Morning.
about dollar strength. I heard you mention that. I read it in your notes. When you look at the S&P 500, roughly 40% or so of the S&P's earnings or revenues, I'm sorry, come from overseas. And right now you've got Europe in a deep recession. You've got a strengthening dollar, which makes it more difficult for other countries to buy our goods and services. At what point do you think that strong dollar starts to exert downward pressure on S&P earnings?
I think you've already seen it, actually, right? So you've seen quite a few companies who are coming out, even the Microsofts of the world, coming out saying, look, we're going to have our revenues certainly decrease. Good hedging policies in place by lots of companies, take the Googles of the world, the Accentures, et cetera. They're actually managing that to the bottom line, and that's, to your point, absolutely correctly. Revenue, hard to manage, obviously, because revenues are what they are when you translate them, but then they manage that into the earnings. And so what you're seeing investors doing is really much more focused on not the growth on the revenues, but much more on EBITDA and on earnings. So to your point, I do think that actually you continue to see a strength of the dollar, which actually in a recession area is actually a good thing. So there used to be this race, as we all remember, the race to the bottom of a currency and the weakness thereof. In an economy like this, a stronger currency is actually better for an economy, while it will impact negatively revenues. And I think that's really important, as you said, for over 50% of revenues in S&P 500 companies coming from abroad there. So, but there are ways to manage it, and there's lots of companies who do it extremely well.
Well, we heard from Ford already taking a hit. We're going to take a look at that and morning mover. But we'll talk about this potential profits recession throughout the program. It's something one of our frequent guests, Stephanie Pomboy, has been calling for now for over a year. Wolfgang, thanks very much for weighing in this morning.